Okay, folks. The same, we'll follow the same procedure that we did for quiz one. The quizzes, Zoe and Chris are going to sort the quizzes in alphabetical order. I'm going to start grading, and I'll let you know when the quizzes are graded. And as I think it'll be sooner rather than later, because I want to get it out of my office. There are first quizzes that still haven't been picked up. I'm going to give you 3 more hours, and then they have to come back into my office because otherwise it gets too confusing. So if you haven't picked up your first quiz, there are about 30 or 40 left. Please pick that quiz up as well. Okay. So, are we in a crisis? I promised you. What did I say at the class? Life will be interesting. I said you're going to pick a company, and things can happen during the course of the next semester where everything can change from under you. I don't wish it on people, but it's happened. It's happened in 2008, the fall. It happened in 2020. It happened in 2001. But how do we separate a crisis from just a bump in the road? What is it that makes for a crisis? Anybody want to give it a shot? Because everything is a crisis on CNBC. What is it that makes for a crisis? There's got to be a trigger action that can potentially make a big difference, not just in the short term, but in the long term, right? 2008, what was the trigger action that led the crisis to start? It was the Lehman Brothers collapse over the weekend. There were, the tween book of a series of unfortunate events. There were a series of unfortunate events leading up to the Lehman collapse. Bear Stearns almost collapsing. But the Lehman collapse essentially was the trigger. So you have a trigger event, then what happens? Investors react. What's the only thing you control as an investor? You don't control what companies do, what governments do. The only thing you control is the price. You sell, you push the price down. The minute you push the price down, we've talked about implied equity risk premiums. What are you effectively doing? You're saying, I feel more risk, I'm going to demand a higher price. During every crisis in the last 15 years, once a crisis gets started, I compute the implied equity risk premium every day. I don't do it for others. I do it for me because that's the only way I can stay centered. You remember what it was at the start of this year? 4.33%. On Monday, actually forget about Monday, on Wednesday of last week, April 2nd, the implied equity risk premium was 4.57%. So it had already gone up during the course of this year. Why? Because it's been a rocky year. So give me a sense of direction. 4.57% on Wednesday. What did the S&P 500 do on Thursday and Friday in percentage terms? Down about 8%, 9%. The NASDAQ was down 10%. So the S&P was 9%, the Dow was 8%, and the NASDAQ was 10%. So over a 2-day period, the index has dropped. So what should happen to the equity risk premium? Other things remaining equal, the expected return on stocks, lower price. For the moment, at least, the earnings and cash flows haven't changed. We'll come back to that because clearly the tariffs can affect that. But at least for the moment, the price of risk has gone up. My Friday estimate, close of trading, was 5.08%. Already you can see your cost of equity for your company has changed over a 2-day period by 0.5%. I'll continue to do it until when? Until I feel comfortable enough to let it go. I don't like doing it first thing in the morning. I'd prefer to drink my coffee and just read the news. But every morning I will continue to do this using the close of trading price. So you'll be able to see the implied premium go through. Okay? So that's the first effect is you got the price change and if you're pulling money out of stocks, remember a lot of the drop in equity is not cash. It's basically just it just goes into thin air, right? About on Thursday and Friday collectively, U.S. stocks lost $5.3 trillion in market cap. Global stocks lost 9 trillion in market cap. Much of it is just gone into thin air, but some of it is in cash, right? So where does the cash go? If you're feeling scared, you pushed up the risk premium, it goes into safe investments or into things that you think will hold their value during a crisis. So first place I looked was the treasuries, and guess what treasury rates did between Wednesday and Friday? I know what 10-year rate you used when you did your cost of equity, but it was 4.58% at the start of this year. On Friday, it hit 4.01%. Today, it's actually under 4%. And that shouldn't surprise you. Money goes into treasuries, treasury rates decrease. So stock prices drop, treasury rates decrease. And if money leaves financial assets, where does it go? Probably into collectibles, most long-standing collectible gold. Didn't go up on Thursday and Friday, but it held. If you have an investment that held its own on Thursday and Friday, that's a win. But to me, the biggest surprise was Bitcoin, because Bitcoin over the last 15 years has behaved like very risky stock. During the COVID crisis, stocks were down 33%, Bitcoin was down 57%. Thursday and Friday, it's very early in the process to pass judgment already. Bitcoin held its value, it was up about 1.6%. Clearly, people are leaving financial assets and they're looking for places to put the money. It's only 2 days in, right? So the question is, what's coming? If history is any guide, there will be aftershocks. If you think of the tariff announcement, and what was it that made it such a surprise? I mean, we've been talking about tariffs all year. So what was it about the Wednesday announcement that made it such a surprise? Yeah. The magnitude and the breadth, right? Everybody got hit. And the amount was staggering for some of the countries. You take Vietnam and you look at the tariff and you say, that's immense. And here's the third reason it was the basis for the tariffs is actually not tariffs from the other country, it's a trade deficit. So if you had a big trade deficit on a percentage basis, you got a bigger tariff. Why does it matter? Because it's not going to be easy for the country to do something to make a trade. I mean, you can bring your tariffs down to zero for US goods, but you can't bring the trade deficit down to zero. How does Vietnam bring its trade deficit with the US down to zero? So it's wide, it's deep, and unless something fundamental is changed about the way it's computed, it's not going to be easy to fix. That was a surprise. But there will be aftershocks. Friday, you already saw one aftershock, right? What did China do on Friday? They counted. So there is this aftershock of tariffs create counter tariffs, create tariffs. So this could become this full-scale tariff war, in which case every other day, 3 days, you're going to. And you're also going to get some positive aftershocks where some countries kind of come to an agreement with the US and maybe the tariffs will be lowered. Maybe they won't go away. So there'll be good news, bad news, more bad than good, if history is any guide. So for the next few weeks, welcome to a roller coaster, right? You're going to get big moves in either direction. 1,000 points will become routine. It happened in 2008. We got used to 200-point moves in the Dow, which at that time were big moves. With the Dow at the level it's at, you're going to get 1,000-point moves in either direction within a day. Will there be a real effect on the economy? Already, likelihood of a recession has gone up from 25 to 50%. I mean, macroeconomists usually don't know what they're talking about, so I'm not going to take that too much to the bank. But clearly, there is going to be an effect on, at least in the near term, Is there any good news in the near term? The good news is inflation might become less of an issue. There might be that one-time, tariff effect, but in terms of oil prices and other commodities, a slower economy does. So in the near term, the economy will slow. Will it go into recession? We don't know. Unemployment will probably go up. Consumer confidence will be hit. The real question is, where does this all play out long term? And anybody who claims to know the answer to that is lying. The one thing we do know is that global trade was good for global growth, that the global economy will grow at a lower rate than it has for the last few decades because you take global trade out. It's Econ 101, right? There'll be less real growth, but it'll create winners and losers. Among emerging markets, Vietnam obviously is far more exposed than India or China. Why? Because India and China have large enough domestic markets that companies can look inward and still be okay. But if you're, I was in Chile on Thursday. What does a country like Chile do? It's a tiny country with commodity exports driving the country. There's not a whole lot of domestic market you can fall back to. So there's going to be a disparate effect, and right now those winners and losers will still get juggled out. We don't know what that'll, and that's going to have a feedback effect. In 2008, markets dropped on the first 2 weeks. Markets dropped 12%, but by the time you got to 6 weeks out or 8 weeks out, markets had dropped 28%. The equity risk premium started at 4, went to 8, stayed above pre-crisis premiums for 15 years. 2008 was long-standing. It made a real effect. 2020, again, you started 4.4% February 14th of 2020. That's the trigger was that news story from Italy saying that they'd found COVID cases in Italy and they had nothing to do with China or cruise ships. Because until then, the delusion we had was it's a pandemic, but if you're not on a cruise ship, you haven't been to China, you're okay. And February 14th was the start of the COVID crisis. By March 23rd, the S&P 500 lost 33% of its value. Treasury rates had gone from 1.6% to 0.76%, a historic low. But the difference in 2020 is by September, it was almost like it had never happened in markets. We were back to pre-crisis levels. Equity risk premiums dropped back. So the script plays out in different ways. And after every crisis, we have postscripts, right? From whom? Everybody. What's the investor postscript looking at 2008 and 2020? Markets always come back. It's an extremely dangerous postscript, but they did, right? 2008, look, and you say, well, I'll just stay through. But the fact that a catastrophe did not happen doesn't mean that the probability of a catastrophe happening was always zero. I remember in October of 2020 when people talked about Morgan Stanley being the next bank to fall, and then Goldman Sachs was going to fall. There was a very real chance, we've forgotten in hindsight, that you could have had 8 banks in a row fall, in which case what the market was actually initially bringing in was too negative that they with COVID we wiped our memory clean, but I'd like you to go back and think about how you felt in March and April of 2020 about how this was going to play out. But by the time you get to 2021, as human beings, we're capable of looking back and say, I knew what was coming. Did you? One of the things I would suggest you do, it's going to be painful for some of you, is keep a journal. And this is something that's a lifelong exercise. When you get to moments like this, put in real time how you feel that every Friday. I plan to do this. I plan to put down, this is where I am. This is what's unsettling me. Because that means you can't go back and clear your history, right? You can't say, well, I was always okay, because I can go back and look at my March 23rd COVID journal entry, which I put online, and say, on March 23rd, you were terrified. You told us so. It's good. I mean, the only way sometimes to be honest with yourself is by making it public so you can't pull it back. I know you don't want this doesn't feel like a learning moment, especially as you look forward and say, what will this do in terms of, will my summer internship get yanked because of this? Because those things are going to be kind of crowding the space. But I mean, my best learning has come at a cost, to my personal portfolio during crises. So while I plan to feel the pain, I will plan to learn from that pain as I go through. And every Friday for the next few weeks, and as long as this crisis lasts, I will say this is where we are. So my first post will go up later today. That's partly what I spent last night writing. So sometime today, and every Friday I plan to update. And the daily equity risk premium will be on my webpage every day. So as you look at your cost of equity or capital, obviously you can't hit a moving target. You got to pick a day to do your cost of capital. But my suggestion is pick a day after last Friday. Otherwise, your cost of equity, cost of capital will become almost fairy tales because the world has shifted while you were doing your project. It's a long assessment, but we're talking about capital structure, right? What if something goes wrong? Perfect lead into what if something goes wrong. You're borrowing, you're deciding how much to borrow last Tuesday. What if something goes wrong? Well, we just discovered what could go wrong. And last session, we talked about what you can do. You can ask what if questions. What if my operating income drops? See how much your optimal debt ratio changes. And with Disney, it didn't change that much. I could drop the operating income by 20, 30, 40%. My optimal stayed at 40%. Here's a second way you can try to get some downside protection. In my original assessment of Disney's optimal capital structure, I concluded that the optimal debt ratio is 40%. Remember that? No, and I gave you a cost of capital, 7.19%, I think. But I didn't tell you what rating Disney would have at that optimal debt. I was just focused on minimizing the cost of capital. What if I told you that at the optimal, Disney's rating was double B? It isn't, but let's say it was, right? There's nothing in the cost of capital that prevents you from going to a double B rating if it will minimize your cost of capital. Would you, as Disney, be a little concerned about a double B rating? Leon, help me out here. What happens when you have a double B rating? First, what's the magic line you fell below? Investment grade, which is triple B, right? So that's, you fall below triple B, you are in trouble, right? Kevin, what's the trouble of falling below triple B? So Derek, I'm sorry, Derek, sorry. Yeah. That's part of it. But what else happens? First, will there be a news story the next day that you fell below investment grade? Yeah. And then what happens? Remember the indirect bankruptcy cost? It all gets triggered, right? Your suppliers say, I saw the news story. I need cash. Your employees are reading that news story and they're going on LinkedIn saying, I might not have a job soon. Could you please put out some feelers to see if I can get a job? Your customers read the news story, and if you're producing long lasting products, they say, you know what, I'm not buying from the company. So the first thing you worry about is, hey, this could trigger a kind of meltdown in the business. In the pre 1981, if you fell below investment grade, another thing happened. You couldn't raise new capital, you couldn't borrow money, you couldn't issue bonds. You know, Mike Milken and Drexel Burnham changed that and allowed you to make original issue bonds, but you couldn't issue bonds. So it was potentially problematic. So you can see why a company might come back to you and say, look, I'm not going to go to your optimal if it puts me below investment grade. So putting an investment grade rating, I think it's a reasonable constraint. In fact, you might want to add a buffer. Say triple B is the absolute bottom, but I want to give myself a buffer. I want to be A minus, even single A. Almost every company I've ever talked to, I don't consult, but I've talked to, has a rating constraint. And most of them have ratings constraints above investment grade. But some of them are completely unrealistic. They say, we want a double A, we want a triple A rating. You ask them why, it's because a higher rating is better than a lower rating. Is it? I remember talking to the CFO of a steel company in Europe. And it was the last AAA rated steel company in the world at the time that I talked to him. And I said, what is it? And the entire company, everything that was done in the company was driven by this rating. So they would look at a decision, say, should we take that project? How will it affect our AAA rating? Should we raise capital? How will it raise it? So I said, look, everything you're doing in this business is driven by that AAA rating. What's the big deal about a AAA rating? He looked at me like I had two heads and said, well, a AAA rating allows us to borrow money at a really low rate. So I said, how do you maintain your AAA rating? And he told me, he said, we never borrow money. I said, this is the circular logic that kind of gets us all into trouble, right? So you want a AAA rating because you can borrow money at a really low rate, but the only way you can preserve that is by never borrowing money. 0 times a low cost of debt is still 0. You might be better off taking an A+ rating and borrowing some money. So when you confront a management with an unrealistic rating constraint, and they say, we want a AAA rating at any cost, rise to the challenge and give them the bill. This is how much it's going to cost your shareholders to maintain a AAA rating. And it's easy to do with the approach we have. My cost of capital is unconstrained, right? My optimal debt ratio was 40%. And at that 40%, the rating for Disney that I got, the synthetic rating was single A. Let's say Disney came back to me and say, we want a AA rating. We prefer a AA rating. You know what I'm going to do? I'm going to go looking for a cost of capital that's minimized, subject to that rating constraint. Look across the spreadsheet. 40% doesn't do it, but at 30%, maybe I can do it. And at the 30% debt ratio, the value that I get for the firm is lower because the cost of capital is going to be slightly higher. By definition, the optimal was the lowest cost of capital. I value the firm at 30% debt and 40% debt, and the difference is about 5.7 billion. So I'm going to go back to Disney and say, you told me you wanted a AA rating. I can do that for you, but it'll cost your shareholders 5.7 billion. They might say, that's good. We need the buffer. That's a small enough price to pay. But then a very conservative member of the management group says, but we would like a AAA rating. Well, I can do that too. 30% puts me at a AA. 20% will put me at a AAA. Well, you can go to 20%. The cost has now risen to 12.1 billion. My only follow-up then is, I need you to get in front of your shareholders and tell them why you're willing to give up $12.1 billion of their money for you to have the bragging rights for being the only AAA rated steel company in the world, or the only AAA rated entertainment company. You can't stop managers from doing what they're doing, but they can at least make them aware of, this is the price you're paying by not borrowing enough money. So why should we do it? The answer is $19 billion. By doing this, you lower your cost of capital. By lowering your cost of capital, you get savings every year. The present value of the savings is $19 billion. And let's be quite clear, the $19 billion is a transfer of wealth from taxpayers. From a societal standpoint, it's not a great way to run an economy. But you have a job. You work at a company. You got to work with the tax laws that you have. But remember, in all of the analysis that we looked at, we borrowed money. And what did we do with the borrowed money? We bought back stock, right? Because I wanted to keep, it was a recapitalization. Disney had big plans in 2013. They wanted to build a new theme park in Shanghai. They wanted to make more movies, buy other movie studios. Fox was not quite on their radar yet, but those plans need a lot of money. And seems counterproductive to go out and borrow 55, in this case, what is it, $40 billion and buy back stock when you have all these investment plans lined up. So I'm going to play the role of Disney managers and ask a question. If I borrow the money, and instead of buying back stock, I took investments instead, built more theme parks, made more movies, would my optimal debt ratio still be 40%? Because the optimal debt ratio is based on that premise of buying back stock. I'll give you a short answer. Yes, if you stay in the same business mix. So if all you're doing is building another theme park, making more movies, making more broadcasting shows, I'm okay because you're essentially expanding your business. Your operating income should scale up over time. But if you're going to borrow the money and enter, I don't know, the AI business, maybe there's an AI entertainment business, I'm going to say, wait, you can't do that because if you do that, it's a riskier business with negative cash flows. your optimal debt ratio is going to decrease because you're going to use that debt to enter riskier businesses that drain your cash flows. I can't give you a blank check. And often when bankers tell a company you have excess debt capacity and they leave, that's exactly what you're doing, right? You're telling the company you have the capacity to borrow money. And they read into that, I can borrow money and do an acquisition. I can borrow money and enter a new business. And that part doesn't follow. So if you ask me to do the optimal debt ratio, I will do it. I'll bring in the AI business, which will be bringing in more risk. So your beta will go up, your cost of equity will go up with negative cash flow. So that'll lower the amount of income I have available to service debt. I might come back to you and say, if you borrow money and enter a riskier business, your optimal debt ratio will no longer be 40%. It'll be 30%. So generically, three questions, and you can see them play out. So that was Disney. Let's see what our other companies look like. Let's move to Tata Motors next, right? Family group company, but standalone company. I did exactly what I did for Disney. I won't torture you by taking you through but it's exactly the same process. Take the unlevered beta, come up with the levered beta at every debt ratio. Take the cost of debt, estimate a synthetic rating based on the interest coverage ratio, come up with the cost of debt, and come up with the cost of capital by taking a weighted average. What's my objective in? Minimize my cost of capital. And in the case of Tata Motors, that happens at about 20% debt. So the right mix, the mix that minimizes the cost of capital, but Tata Motors is 20% debt, 80% equity. Tata Motors was actually at about 29% debt. Not a huge over leverage, but clearly they have too much debt given their capacity. Now, if this were a standalone company, what would you do? You'd go to them and say, you know what, you need to bring your debt ratio down. No hurry. You're not in any distress, but it looks like you have too much debt. I did this for Tata Motors, Tata Steel, Tata Chemicals. They were all slightly or fairly moderately over levered. And then I did Tata Consulting Services, another company in the same group, and it was massively under levered. Now, this might be just me, but it looks to me like Tata Motors, Tata Steel, and Tata Chemicals are borrowing money, and banks are lending the money on the assumption of what? If the company gets into trouble, the family will not let the company go down. They're lending, it's like lending to a prodigal son based on the fact that the father is wealthy, saying, hey, he's not going to let this son not pay the debt, he's going to pay it. It's a dangerous way to lend because you're lending not on debt capacity of the person borrowing, but on somebody backing up the borrower. And people did this with Dubai ports about 15 years ago, expecting Abu Dhabi, which is the money bags in the United Arab Emirates consortium, to step in and back the debt. Debt comes due. The bankers expect Abu Dhabi to do it, and Abu Dhabi looks at the debt agreement and says, we don't see our name here. It's one of the most famous. In fact, it's after that the ratings for the different parts of the UAE ended up diverging because now we have different ratings for Abu Dhabi, Dubai, and the rest of the UAE put together because of that. But it looks to me that Tata Motors is borrowing you, which is good for Tata Motors shareholders, right? So who's paying the price? Who's subsidizing this? Tata Consulting Service shareholders. They're the ones who should be pissed off saying, why are you taking our debt capacity and letting Tata Motors, Tata Steel, and Tata Chemicals, which are companies completely unrelated to us as investors, do it? But in family group companies, don't be surprised to see strange debt mixes at individual companies because the family looks at the entire grouping of companies, say, hey, how much can we borrow as a group? And then maybe subsidizes some companies by letting them borrow too much and lets other companies borrow too little. Any questions on family group companies and the subsidy effect? Then I looked at Vale. What's the big deal about debt capacity for a commodity company? Is even if you're a mature, large commodity company, your earnings are going to go up and down based on what the commodity price does. So I did Vale's optimal debt ratio, and at the existing iron ore prices, and I came up with an optimal debt ratio of 30%. That's good, right? You have 30% optimal debt ratio. They were actually at an actual debt ratio. Their actual debt ratio was closer to, if you look across time, their actual debt ratio was much higher. The CFO of Vale for a while was a student from this class. So I remember I emailed him and said, look, I see that you have too much debt. What's going on? Why are you borrowing? And he gave me a very sensible answer. I'm not sure whether it holds up. He said, we borrow money not based on last year's operating income, but the operating income we can deliver over a cycle. That kind of makes sense, right? You're an oil company, you have good years, you have bad years. As long as you set aside money in the good years to cover the bad years, you go out and borrow money based on the average of the cycle. So that's what we're doing. We're not over levered if we replace the actual operating income with a normalized operating income, an average over time. And it turned out that if, in fact, you replace the actual with the optimal, you ended up with the debt ratio closer to what they had. The logic makes sense, but if you're a company borrowing against a cycle and you're at the down end of the cycle right now, you're borrowing, the current earnings are not high enough, what's your biggest worry? Do cycles always repeat? Commodity price cycles have been around well, sometimes, most of the time they do, thank God for that, but there are times when the cycle breaks. The first part of this century, the iron ore price cycle was broken by China buying so much iron ore for their infrastructure that they pushed up the cycle price on average almost 50% over previous cycles. 2013, you still had that China high in iron ore prices. So Vale is borrowing based on an average price that's pushed up by China buying huge amounts. But even China at some point in time is going to scale down its infrastructure investment. And if that happens, you're going to return to a cycle, but not the cycle you saw over the last 10 years, but maybe the cycle over the last century. I mean, how you normalize is entirely an empirical question. You might go back the last 10 years, you might go back the last 50 years. So I understand why commodity companies sometimes borrow, but take a look at the longest surviving oil companies. Royal Dutch, Exxon Mobil. You know how much debt they usually carry? Very little. 13%, 10%, 15%. Take a look at the shale oil companies, much younger companies, they borrow 50, 60, 70%. What did oil prices hit today? They fell below 60 today. And who knows, they might be below 50 by the time the week is over. Those companies that borrowed money at $80 oil prices expecting this to continue are now going to be in deep trouble. There's a reason Royal Dutch and Exxon have survived, which is they actually borrow money looking at oil prices saying there will be times when oil prices drop and stay down and we're not going to be able to service the debt. If you're a commodity company, you're still borrowing money based on operating income, but whether that operating income is last year's number, an average number, the lowest number you get over the cycle is going to be up to you. Let's look at Baidu, technology company. Lots of growth potential, right? You're saying, so what? Lots of growth potential pushes up your market cap. Remember, our debt ratios are a percentage of market value, not a book value. So when I say a 10% debt ratio, it sounds low, but if your market value is huge, that debt is also going to be huge. I mean, I know NVIDIA is no longer a $3 trillion company, but let's say it's a $2.4 trillion company right now. And I say NVIDIA should go to a 10% debt ratio. Doesn't sound like much, right? But what's 10% of 2.4 trillion? 240 billion. That's a lot of debt. With high growth companies, small percentage of debt will translate into large debt values. And not surprisingly, if you look at the optimal debt ratio for Baidu, it tends to be low. I know some of you are valuing younger companies, growth companies. When you do the optimal debt ratio of your company, don't be surprised to get a really low optimal debt ratio. Could your optimal debt ratio be 0%? Yeah, if your market cap is high enough, because all I required is you have a money-making company, right? It might make money, but it might be a tiny percent of market cap. Your optimal debt ratio can be 0%. It is not unnatural. It can happen. In that case, you shouldn't be borrowing money. Your cost of capital will only go up. And finally, I decided to do my private business. And here I ran into a measurement challenge. Remember when I did the Disney optimal debt ratio, I started with the enterprise value for Disney. How did I get that? I took the market value of equity, added debt minus cash. publicly traded company. That's easy to get. With the private business, though, I run into a problem because there is no market value of equity. And here's what you cannot do: you cannot use the book value of equity. It's not even a starter in the game. So to start the process, I had to make an estimate of how much the equity in this private business would be worth, and I cheated. I took a very simplistic approach. I took the net income of the company, in this case 1.575 million. I multiplied it by the average PE for publicly traded book companies. I know it's a very rough approximation, and use that as my market value of equity. So when I computed the enterprise value, it is with this market value of equity, 31.5 million, replacing the book equity. Then the rest of the process flows through just like the other companies. And here, if I continue to use the total beta, the optimal debt ratio is 30%. Again, the place where you minimize the cost of capital. Their actual debt ratio was actually 28%. They're pretty close to their optimal. But here's the difference in public and private businesses. Public companies, when you're significantly underlevered, I'm going to get in your face and say, hey, this is how much you're leaving on the table. If you're a private business and choose not to borrow money, I'm going to just back off. I'm going to give you the facts. I'm going to back off because why aren't you borrowing money? Because this is your entire wealth. It's tied up in this company. You have a family, you have children, tuition to pay, healthcare bills coming up. I shouldn't be the person saying, go out and borrow money, and then you get into trouble and you go bankrupt and your children end up on the streets and I'm going to be blamed. You're a private business. It's your money. It's your business. If you choose not to borrow money, that's your choice to make. I'll give you a sense of how much you can borrow if you needed to. But with private businesses, with your own wealth, you get to make choices that a manager at a publicly traded company. So when a manager at a publicly traded company says, look, borrowing money makes me uncomfortable, you know what I'm going to suggest? A therapist, maybe some medication. Or if you really, that doesn't work, quit the job, go find a job that makes you comfortable. You're managing other people's money. You can't make choices based on this makes me uncomfortable. I know it sounds harsh, but it is other people's money, and you're a custodian of that money. You got to make the best choices. So the U.S. Tax Reform Act in 2017, we're heading into another tax reform act. So there will be, so you picked a great year to take corporate finance. Everything is in motion, right? 2017, two things happened. One is the marginal tax rate, which was 35%, was dropped back to 21%. For those of you wondering why the tax rate I report for the US is 25 or 26%, it's because 21 is the federal tax rate, but you have state and local taxes. But there was a big drop. So holding all else constant, that alone should make it less attractive to borrow money. The other thing that happened, and I mentioned this, is in 2017, they also put a cap on your interest expenses, which is your interest expenses, if they exceeded 30% of your EBIT, you were allowed to take the interest expense, but you couldn't claim it as a tax deduction. Both of these things will work against the tax advantage of debt. So at least looking at the tax law, your reaction should be, oh, the amount of debt at US companies should decrease because of the tax law. So I've been tracking dollar debt and debt ratios at US companies, so if you take Disney, okay, I actually, right after the tax law was passed, I computed the optimal debt ratio for Disney. So I said, tax rate has changed. I was using 38, 39, 40%. I'm now using. And surprisingly, the optimal debt ratio didn't change. It stayed roughly where it was. But here's what changed. See the orange line? That was my value for the firm at different debt ratios under the old tax rate, the higher tax rate. See the gray? That's the value of the firm with the new tax rate. So what do you notice? At every debt ratio, the value of the firm I'm getting is lower. Why? Because I get less of a tax subsidy from debt than I used to. Which makes sense, right? 35% to 21%, you're getting less tax benefit. Why isn't it translating it to a lower optimal? At least for Disney, it didn't make enough of a difference to change the ratio, but your cost to capital effect is going to be smaller, your value effect is smaller, even at that same optimal debt ratio. And collectively, if you look at US companies, I'm sorry to do this to you, I really didn't need a graph. I could have just put it as numbers, but I just love these fat column graphs in Excel. Yeah. Okay. So if you look at this, this is the total debt, the green. And if you can look at over 2017, 18, and 19, the total debt after the tax code change actually crept up. So you're saying that doesn't make sense. Why would companies borrow money? If I, and this is a problem with if you come in with a prior, you can very quickly find something that backs it up. So if my priors are companies don't care about taxes when they borrow money, I'd point to that dollar value of debt and say, look, they're borrowing more money. But let's say I had a prior that says companies do care about taxes. Instead of showing you the dollar debt, I'd give you the debt to EBITDA. That's how much debt you borrowed relative to EBITDA. And that number has decreased over time. In fact, over the last 6 years, the total debt to EBITDA for US companies has dropped fairly significantly from pre 2017 levels. So, to that notion that this crisis is somehow caused by companies borrowing too much money, there's no data to back that up. Companies borrow less money now than they did pre 2017, which makes sense. Perhaps not as big a drop as you'd expect, but you see it in the total debt. So, those are all factors to think about when you think about it. Now, before you try the cost of capital approach in your company, and as I said, I sent you the Excel spreadsheet, you can come up with the optimal. There are three things about that tradition. I like that cost of capital approach. It's nice, it's easy, it's adaptable, but there are three limitations. First is because I have to start with an operating income, that kind of makes it static, right? Because it takes 1 year's operating income and builds an entire castle on it. And as we saw in the last 2 days, operating income can be affected by external events. Second, it does ignore indirect bankruptcy costs, right? I take the rating, I put in the cost of debt, but I don't factor in that if your rating drops, your revenues and operating income could be affected because people don't buy your goods. And third, it does make assumptions about betas and ratings that can give me costs of equity and debt, which are unrealistic, especially at really high debt ratios. So concede it. But there's a way in which you can fix each of those problems. And that's the second approach, and I at least want to get started. It's called the enhanced cost of capital approach. The enhanced cost of capital approach, there are two things you change. First, the operating income that I would show you at every debt ratio will not be fixed. If you remember the EBIT stayed the same at every debt ratio for Disney, the original approach. Here I'm going to look at your rating. And if your rating drops, I might actually have a feedback effect where your revenues and operating income will also drop. I have to show you by how much. But so two things go into motion now, right? When you change your debt ratio, your rating drops, your cost of capital will change, but your operating income will also change. So already you can see that the optimal debt ratio of your company might not be where your cost of capital is minimized. It'll really be at where the value is maximized. The two diverge because both numbers are in motion. You can also build in, remember we talked about, Monte Carlo simulations when we talked about projects. If you wanted to get fancier, you could make this a simulation, see what the optimal debt ratio looks like given different hits to the operating income. So here's what I did to bring in that indirect bankruptcy cost. As long as your rating is up a single A or above, I said there's no effect. Things are fine, nobody's going. When your rating drops to A minus, if you're a pretty large company, you still have no effect. You drop to triple B, you start to see the first effects. People are starting to get nervous because you're getting closer to that investment grade edge. You drop to double B plus, another 5. So you're saying, where do you come up these numbers? Well, I might have made them up, but I'll make up a reason why I came up with the numbers. Do companies sometimes get downgraded? Yeah. I look at the operating income in the following year. And if the operating income decreases, I look on average how much the operating income decreases. So I have three groups of companies, low, medium, and high. And if you're in a high risk company, you can see the effects are much greater of your operating income dropping and your rating changing. So that's going to be the big difference in this analysis. So if you want to compare this table to the table I had with the traditional cost of capital approach, as my debt ratio changes, my cost of capital changes. The cost of capital is minimized still at 40%. But now if you look at the value effect, it's smaller because I now also change the operating income at every debt ratio. So in the case of Disney, I still get the same optimal debt ratio. But there are other firms, when you introduce this distress cost in, that you might end up with an optimal debt ratio lower with this approach than with the traditional approach. So traditional approach, all you do is focus on minimizing cost of capital because everything else stays fixed. And you minimize your cost of capital, firm value is maximized. The enhanced cost of capital approach, you change your debt ratio, both the operating income and the cost of capital change. One final point, and I'll at least set it up. Is there an optimal debt ratio for a bank? What do you think? Can a bank be over levered? I didn't even know what that would mean, right? Because banks borrow money to lend out. But can a bank have too little equity? Yeah, that's what regulatory capital ratios are. So when you think about banks, it's not do they have too much debt, it's do they have enough equity. So with banks, rather than focus on cost to capital at different debt ratios, you're focused on what is the right amount of equity that this bank has to have. And the regulatory agencies start you off, right? There's a minimum regulatory capital ratio. So it's not even a choice. You have to have enough equity to get you above that minimum. Tier 1, Tier 2, Tier 3 capital. But if you're a bank and you're a sensible bank, you're not going to stop at the minimum. Why? Because you want to build in a buffer. The reason you build in a buffer is bad things can happen. You take a big loss, a trader goes crazy and loses 2 billion. Guess where it comes from? It comes from your regulatory capital. You have a big loan that the borrower does not pay back, it comes out of your regulatory capital. You have a bad year for the company, you lose money, it comes out of the regulatory capital. So there's a regulatory minimum which you essentially can look at. But there's going to be a regulatory capital ratio that you choose to have. And if you're a conservative bank, it'll be much higher than the regulatory minimum. But the bottom line is debt to a bank is raw material. It's not a source of capital. There's no such thing as the cost of capital for a bank. You have to stop at the cost of equity. When banks talk about capital, it's almost always equity capital. So next session we start, I'm going to use that to kind of come up with what's the right amount of equity for a bank and what do I do if I don't have enough equity. I will see you on Wednesday. Restaurants, I think it stays the same. I only have 50 or something. Does it make money? That's one thing. Revenue will always be positive.
And it's stock that I syndicated this game.
You're going to have dividends and the other places, the more risky you become as a company, the more value the man can. But it's an indirect way of doing it. You're doing it because the traditional ways are not working. People are not willing to buy in shares. It's not that good or bad. It's just that if you have a cash flow, the cash pay the dividend, you should do it. It's because you can't do that that you have to think about creative ways of raising equity where people look past your losses and they can use it. Only few things to do. You're a young, money losing, risky company with the only thing you're equity, very, very risky. Normally that'd be a terrible thing with equity, or warrants and claims. So it's not that warrants are good or bad, but the young company, and that's why you get the young startups often everything they do is conversion. This is just an option they have. Even their debt is all, it's really all options. It's tiny debt stuff, right? They're raising money through warrants because they're taking advantage of the only thing they can bring to the table. That's the point. It's very risky, a lot of upside. So why don't you buy our warrants there? Financials look like crap right now, but you're not buying today's financials. But for a traditional company using warrants, it's not that it's a bad thing. It seems like you're giving away something that
I asked you, I know someone was in that world.
the young startup world.
Not the world, startup world, the financing end of that world, and then. A lot
In
of.
fact, if you give capital to any young company, it'll be treated in auction as part of it, right? Because why do you give capital to your company? Because of the potential upside. You shouldn't, that's why venture capital debt with no option is a catastrophe waiting to happen. Because no matter how high the interest rate is,
By the way,
you don't get the upside, you get all of the downside. So if you're doing venture capital debt, make sure you always add an option to that debt, where if there's upside, you get at least a slice of the upside. You're welcome. Hi, how are you? Not a problem. Centers on the ninth floor, okay. Yeah, before your grade goes through, maybe a little more than 3 hours, but maybe like 6 o'clock or so. I thought it was 6 o'clock, I thought.
Look, today the law is not really like a lot of times, I think they make it feel like. Yeah. And they just like, because it looks bad, not, like too much. But, well, I was gonna say, let's get.